If you are a first-time investor in Canada in 2026, the single biggest advantage you have is access. You can open a Questrade or Wealthsimple account today, deposit money, and own a piece of over 13,000 companies around the world in a single transaction for less than 20 cents per $100 invested annually. Most Canadians do not know that. Even more have not done it yet. This video gives you 10 specific picks, ETFs and equities, all TSX listed or TSX accessible, all designed for beginners, all with real data behind them. One pick on this list is so simple, so cheap, and so well constructed that it may be the only investment a first-time Canadian investor ever needs. I will tell you exactly which one that is at the end. Ticker XEQT. Management expense ratio 0.20%. That is $2 for every $1,000 invested annually. XEQT holds over 8,000 individual stocks from Canada, the United States, developed international markets, and emerging markets, all in a single ETF. As of January 2026, it had generated 127.21% in cumulative returns since its launch in 2019. In 2025, it returned 20.45%. As of January 2026, the fund manages approximately $12 billion in assets. It pays distributions quarterly, which is psychologically useful for newer investors who want to see the ticker VEQT. MER, approximately 0.20%, with the management fee reduced from 0.22 to 0.17% in November 2025. VEQT holds roughly 13,850 stocks globally as of January 2026. It allocates roughly 44% to the U.S. total market, 30% to Canadian equities, 17% to developed markets outside North America, and 7% to emerging markets. In 2025, VEQT returned 20.45%, identical to XEQT. The fund manages approximately $10 billion in assets. The practical difference between VEQT and XEQT is minor. VEQT has a slightly higher Canadian home country bias and pays distributions annually rather than quarterly. For a first-time investor, either one works. Holding both is not wrong. Ticker XIU. This is the oldest ETF in Canada, launched in 1990. It is also the largest by assets under management. XIU tracks the S&P/TSX which is the 60 largest companies on the Toronto Stock Exchange. That means Royal Bank, TD, Shopify, Canadian Natural Resources, Enbridge, and Suncor, the backbone of the Canadian economy in a single fund. Dividend yield, approximately 2.3%. According to Motley Fool Canada, X1U has roughly doubled over the past 2 years as of early 2026, driven in part by a commodity bull cycle in precious metals and key minerals, sectors that make up a significant portion of the TSX. For a first-time investor who wants pure Canadian blue-chip exposure, XIU is the most established vehicle on the market. Ticker VCN, MER, 0.05%. If XIU gives you the 60 biggest Canadian companies, VCN gives you the broader Canadian market, 205 stocks including large, mid, and small cap companies. The average annual return for VCN since inception is 8.5% as of January 2026. The 5 cent per $100 fee is one of the lowest available for any Canadian equity ETF. For a first-time investor who already holds XEQT or VEQT and wants to add a dedicated Canadian tilt on top, perhaps because they want more domestic exposure without currency risk, VCN is the most cost-effective way to do it. Ticker ZEB. Dividend yield, approximately 2.9%. ZEB tracks an equal weight index of Canada's 6 major banks: Royal Bank, TD, BMO, Scotiabank, CIBC, and National Bank. Unlike a market cap weighted fund that concentrates in the biggest bank, ZEB gives each institution the same allocation. That matters because it reduces over-reliance on any single bank and captures upside from mid-size institutions that may outperform. Canadian banks are among the most stable and profitable financial institutions in the world. They operate in a regulated oligopoly, carry strong balance sheets, have paid and grown dividends through multiple recessions, and benefit from rising loan volumes as housing and commercial activity resume. For a first-time investor who believes in the Canadian financial system, ZEB is the single cleanest expression of that thesis. Ticker VDY, MER 0.22%. VDY focuses on Canadian dividend-paying stocks, heavily weighted toward financials and energy, the two most reliable dividend sectors in Canada. It targets companies with above-average dividend yields and has historically delivered a higher income component than a broad Canadian index fund. For a first-time investor who wants their TFSA or RRSP to generate visible cash flow while they hold, rather than waiting entirely for capital appreciation, VDY gives you that income focus without requiring you to pick individual dividend stocks yourself. Ticker ENB. Enbridge is North America's largest energy infrastructure company and one of the most consistent dividend payers on the TSX. In December 2025, Enbridge announced its 31st consecutive annual dividend increase, raising the quarterly dividend to 97 cents per share, or $3.88 annualized for 2026. The forward dividend yield as of early March 2026 is approximately 5.3%. The company transports roughly 30% of North America's crude oil and 20% of its natural gas. For a first-time investor, ENB is not a bet on oil prices. It is a bet on pipeline infrastructure fees, which are largely regulated and contracted. The cash flows are predictable. The dividend has grown for over 3 decades, and the 2026 guidance targets EBITDA of $20.2 to $20.8 billion. Ticker RY on the TSX. Royal Bank is the largest company in Canada by market capitalization and one of the most profitable banks in the world. It recently completed its acquisition of HSBC Canada, the largest bank acquisition in Canadian history, which substantially expanded its personal and commercial banking footprint. The quarterly dividend declared for May 2026 is $1.64 per share, translating to an annualized $6.56 and a dividend yield of approximately 2.75% as of late February 2026. The 3-year average dividend growth rate is 8.76%. For a first-time investor who wants individual stock exposure to the Canadian financial system, Royal Bank is the blue-chip foundation of that argument. Ticker CNR. Canadian National Railway is one of only 2 Class 1 railways in Canada and operates the only rail network that reaches 3 coasts, the Atlantic, Pacific, and Gulf of Mexico. CN moves more than 300 million tons of goods annually: grain, potash, oil, automobiles, consumer goods. And its pricing power comes from the fact that rail is the cheapest method of transporting bulk commodities across North America by a significant margin. Short-term, CN has faced political headwinds from U.S. trade tensions. Long-term, the rails outlast administrations. For a first-time investor with a 10-year horizon, CNR is a toll road on the Canadian and North American economy. Difficult to disrupt, impossible to replicate. Ticker XGRO MER 0.20%. XGRO holds 80% equities and 20% bonds. It is the slightly more conservative version of XEQT. For a first-time Canadian investor who is nervous about putting 100% of their money into stocks, XGRO offers the global diversification of XEQT with a built-in bond cushion. During equity corrections, the bond allocation acts as a stabilizer and allows the fund to rebalance automatically, buying more stocks when prices are lower. For a beginner whose biggest risk is panic selling during a 15 to 20% market drop, XGRO reduces that risk without requiring you to understand bond markets at all. Simple, cheap, built for staying invested. 2 things worth knowing before you act. First, T, F, S, A, and R, R, S, P. Account types matter more than which specific fund you pick. Gains inside a TFSA are completely tax-free. Every dollar of growth, dividends, and capital appreciation stays yours. That compounding advantage over 20 or 30 years is enormous. Put your investments in the right account before you worry about which ETF to buy. Second, the biggest mistake a first-time investor makes is not picking the wrong fund. It is not starting because they are waiting to feel ready. Both XEQT and VEQT returned over 20% in 2025. Every month that money sat in a savings account was a month it was not compounding. Question for the comments: are you already in any of these, or is this your starting point? Drop it below. And if this helped, subscribe. One sourced money video per week.